All right. Thank you for joining us. This is Tim Travis, CEO of TNT Capital Management, and you are watching the Dynamic Investing Podcast. Watching or listening, either one's fine. All right. And so today we have a fun episode. We're going to talk about strategies to build wealth, a template to create wealth. And I want you to know that you don't have to come from money. You don't have to, be a doctor or a lawyer making $500,000 a year to create real wealth. Sound financial discipline, smart decision making, reasonable spending habits, smart saving habits. That'll get you there. Especially the earlier you start, the better. So let's go ahead and let's get started with the first strategy. So the first one seems simple enough, and it's make more money. All right. So if you're watching this, I assume you have a 9 to 5, perhaps you're retired, and that's perfect. And so what I recommend to most clients, if they can, is have some type of side gig. It could be something. I have a neighbor that bakes beautiful cakes and sells them in our community. We have a large community, homeowners community, and it's incredibly popular. Excuse me. And I know a lot of people that do charcuterie boards, or if you're retired, perhaps you're doing consulting. Both my dad and my father-in-law, they've done that for years, and it's a great avenue. So not only are you bringing in additional revenue, you're staying active, right? So your brain's working. A lot of people get bored in retirement. If they get tired of golfing a lot, and maybe that's not you, but financially it can pay legitimate dividends to have that side gig. Another option is maybe you open up a store on Amazon or something like that, where you're bringing in goods from a like a Alibaba or something like that, and then selling them, in the United States. Obviously, you want to do everything legal, no counterfeit goods or anything like that. So you got to be careful. But what having a side gig is going to do is also enable you to make retirement contributions, right? So maybe you could do a SEP IRA or a simple IRA or a solo 401k. And so that's going to allow you to save a lot more on a tax deferred basis. And also expenses, home office, internet, cell phone, your business meetings. These are costs that you're going to be able to write off, and it's going to save you a lot of money. So man, if you can do that, it's huge. And I'll tell you a true story. So when I started TNT Capital Management, I was working at another company. I was working for at a commodities and options company, investment company. And I learned a ton there. I learned a ton about marketing. I learned a ton about different trading styles. And I learned what worked and what didn't work. And in my off time, I just consumed all I could on Warren Buffett, Benjamin Graham, Charlie Munger. I wanted to see, why these people were so successful. And I realized that they used a value investment strategy. They opened up their own investment advisory practices. And I thought, why not emulate that? Like, why am I going to try to recreate the wheel? These people became billionaires doing this. So in my spare time, that's what I did. And it changed my life. It opened up all of the doors in the world to me, when I did that. And it takes time, it takes effort. A lot of people aren't going to believe in you, but look, believe in yourself. It doesn't, a lot of businesses don't require a huge amount of capital to start. That's one of them. So that's a little bit about that, but that's the first strategy. Don't worry, they won't all be so long, but I'm passionate about that one. Number 2, all right, spend less money on non-appreciating assets. So, non-appreciating assets, cars, right? You drive off the lot and your car's worth $15,000 less than when you bought it. That's terrible. So, you don't need to impress people with your car. You don't. For me and my wife, we went many years having just one car between us, and we have 2 kids. and we did it because I could work from home a lot, and it worked, and it saved us a ton of money, and it allowed us to invest that savings. Now, as the kids have gotten older, they go to school and they're in sports and stuff, and so we had to get another car, and that's fine. And look, your situation, you might need multiple cars right away, but think about it. Like a lot of people now, they don't even think, can I get by with only one car? That sort of thing, and it saves you a lot of money because cars are depreciating assets. Other ones, purses, designer purses, expensive clothes. And don't think I didn't fall for a lot of these mistakes. I did, and it was stupid. And so learn from other people's mistakes. But I tell people, get your first $1 million. Once you have $1 million of investable assets, the compounding benefits from that, the flexibility that gives you. And it's kind of a goal. It's like, all right, like once you do that, you're probably realistically not going to want to waste money on depreciating assets anyways, but at least then, you've earned it. So that's number 2. Number 3, invest early and often. Okay. This is huge. Get your kids investing, set up the education accounts for them. Maybe they work for you, and are earning, a salary off your side hustle, and you're able to make IRA, you're able to help them make IRA contributions. So there's a reason why Einstein said that compounding is the 8th wonder of the world. And it's because that money, rule of 72, right? If you're making 12% 6 years, for 6 years, you're doubling your money. And so the earlier you start, the easier it gets. And save, put away that extra money, put it in an invested account and let it grow and see what happens. And it doesn't all happen overnight. Be patient, but the time in the market is the key. And Charlie Munger says that is like the big money's made in the waiting. And a lot of people, they're trying to go in and out. They're trying to do all these things. But you want to wait, you want to let your investments grow, be patient, and that'll pay off enormously for you. So that's a key rule. Rule number 4 is kind of the inverse of number 2. Buy appreciating assets. Okay, appreciating assets. What am I talking about? Stocks. Stocks are fractional shares of a business, right? And so, if you're buying good companies, you've got competent management, good business models, right? Coca-Cola, heck of a business model, and obviously things like valuation and stuff like that matter. They matter immensely. But you're buying stocks that the management team's working to grow. They grow over time. There's inflationary impacts, all this sort of thing. So that's one. Real estate, another great one. Real estate. If you buy a multifamily property, you're expecting to generate cash flows, not just for years, but for decades from that property. That's huge, and then, you have the inflationary impacts there as well. And so these are the types of assets that just are enormously valuable. And if you think about many people, their best investment they ever make is their home. And I'll tell you why. It's not because real estate's the best investment. I don't think it is. It's good, but it's because they're forced to save and invest in their home. They have to make those mortgage payments. They can't spend that money frivolously, right? And so they're in the market for decades for their home often. And so it comes up and it becomes this amazing asset, right? And so that is what you want to think about. You want to buy these and be patient. All right. So the next one, let's talk about another one. This one, it seems pretty common sense, and a lot of these are. The best financial advice is usually common sense. So do everything you can to not get divorced. Okay, because one of the things Charlie Munger said is he says always invert, right? Find out how you can blow yourself up financially and don't do that. It's like if someone tells you where you're going to die, just avoid that place, right? And look, I'm just talking financially. I'm not talking about any other aspect of it. My parents got divorced when I was in high school, so I lived it. And it doesn't mean a lot of people get married and remarried and they have great lives, and that's fine, you know. But just financially, anyone would tell you it sets you back a lot, right? Because now you're paying tens of thousands of dollars in legal costs. Maybe you have to sell your home, and I can tell you horrendous stories of selling at ridiculous prices and missing out on all that appreciation. You know, alimony, you know, child support, all this stuff that happens, and it's expensive, and you just have, I mean, a lot. It's great for the attorneys, right? So, you know, do what you can to avoid that. Sometimes it's going to happen. It's not the end of the world whatsoever. You can adjust. That's one of the things we help folks with is just, you know, making adjustments to their lives and portfolios, etc. But that's a big one. Number 6. This is kind of a fun one. So maximize and optimize your IRA and 401k contributions. What do I mean? All right. So if your company has a match, if you have a 401k and you have a match, definitely contribute up to the max. Okay. So if it's 3%, contribute at least 3%, 4%, whatever, right? That's free money. Now, 401ks could be great, you know, but a lot of them, they have kind of high fees. A lot of them have very limited investment options. So you don't necessarily have to invest all of your, you know, retirement contributions in a 401k. You can also still set up IRAs. So you're subjected to an annual limit of contributions you can make. So you're going to want to talk to your financial advisor or your tax guy about what that is. But don't feel like all of your retirement investing has to be in the 401k. I talk to a lot of people in 401ks, 403bs that really don't like the options, and then they show me what their options are, and they're not great, you know. So there's flexibility there. Another key strategy is Roth conversions. So, you know, Roth is probably the most powerful investment tool we have, other than compounding. It's you pay taxes up front. It's you know, after tax dollars, but that all the growth is tax free and the withdrawals are tax free. So as long as you're invested for 5 years, or as long as that money's in there for 5 years, at 59 and a half, you get full control over it. It's huge. I mean, imagine $1 million, $2 million, $3 million in a Roth, you know, IRA in retirement. How great that is. So even if you make too much money, I believe in 2023 for a married couple, for instance, if you make 228,000, you can't invest in a Roth straight up. There still are backdoor conversions. So what you can do is you can convert, you know, a portion or all of your 401k or your traditional IRAs into a Roth, and then you're going to have to pay taxes, right? And so what we talk about this as is chunking. So let's say you have a $15,000 cushion between your current tax rate and a higher tax rate. Well, maybe you chunk, you know, 10, 12,000, $13,000 of your IRA into the Roth IRA. And yes, you're going to have to pay some taxes on that, but you're not going to go to a higher tax rate if you do that correctly and work with your advisors on that. And all of that growth is going to be tax free. It's huge. So the earlier you start, the better. But that doesn't mean it's a bad idea in your 50s or anything like that. So, you know, I mean, it's not as good, but it still can be huge. So take advantage of that. Roth conversions are fantastic. You know, so the next one we're going to talk about is estate planning. So when you're young, there's nothing less sexy than estate planning. Like, you just don't care, or you think it's only for rich people, you know, but the reality is estate planning is essential. So my number one thing on estate planning is the simple stuff. Okay, are your beneficiaries on your accounts correct? Because guess what? There's times when people will, you know, bequeath their investment accounts to an ex-wife from 25 years ago that they don't talk to just because they never changed their beneficiary, right? So that matters. Insurance, and you know, insurance is as you get older, I think it becomes more important for everybody. But the earlier you start and the earlier you get your insurance, the more affordable and the better deal it's going to be. So, I mean, I'm in my early 40s. I can't tell you, how many people that are my age or younger than me that have passed away and that have left, families, unfortunately. And it could be a car thing, it could be, some other type of health issue. But I have two daughters and a wife, and I'm the sole provider for my family, and it would be devastating for them if I wasn't, taken care of in that sense with insurance and sound financial discipline, because I mean you got to pay off a mortgage, all this sort of thing, right? So that's key. And the younger you are when you get insurance, the easier and the cheaper it is. There's two different types. There's term, there's whole life. There's we could talk about the pros and cons of both, because they're pros and cons of both. There's not a universal perfect solution, but depends on what you want to do. Also, if you're incapacitated, who do you want making decisions on your health and your finances? Maybe your spouse. I mean, is your spouse a gambler? Not that there's anything wrong with it, but do you want them managing your assets necessarily? No. Or a big spender at Louis Vuitton or whatever. Maybe the right person is your dad or a child or whatever. I mean, whoever it is, your aunt, whatever. But the estate planning process makes you take on these questions and think about things. And what do you want to do? What do you want your legacy to be? Charitable contributions. I mean, do you want to give all your money to your kids? If you're really wealthy, do you want to give it all to them? Or do you want, is that in their best interest? Because I mean, a lot of people, they inherit wealth and they become nightmarish people. Sometimes it's not a benefit. It can be a curse. Maybe you just want to give it to charity. But let's talk about those in estate planning. And so the last strategy I want to talk about is credit cards. Okay. So avoid credit card debt like the plague. And I'm not trying to mince words, because I mean, this is a killer. Rates are 25 to 30% on credit cards. It's devastating. Arguably the most successful investor in history is Warren Buffett. And he compounded money at 20% a year. Well, I mean, how could you expect to get ahead if you're paying 25 to 30% on credit card debt? You can't. It's not possible. You're not going to do it. So you got to avoid it. And it doesn't mean don't use credit cards. I use credit cards for almost everything I do. But I pay it off. I pay off the balance, every month. And so I'm never paying a penny of interest. And I understand why people get in credit card debt. It's very easy to get into. Maybe you just want to buy a cool, Christmas gift for your girlfriend or your boyfriend or whatever, and you're maybe you just you feel like you have to do stuff. You feel like you need to go on that trip. And I'm a big proponent of travel, but not using credit cards and paying interest to do it. You can't do that. It's financial suicide in many respects. So avoid that. When you pay it off monthly, you're still getting the points. It's going to allow you to, travel more inexpensively. You get free miles, free hotel stays, that sort of thing. Great accountability, but you're not paying interest. You can't. You got to understand there's good debt and there's bad debt. When interest rates were 3% on a mortgage, I personally think people, were making a mistake financially by not having a mortgage, even if you're retired, honestly, in that sense, because you can do spread income, right? So if you're paying 3% on a mortgage, it's pretty easy to make more than that, through investment. So in my opinion, that's great debt. It's backing real estate. Real estate's appreciating over time. Doesn't mean you want a ton of it. But credit card debt, auto debt, student loan debt, you have to really think about it. It doesn't mean you shouldn't. I mean, I get it. I've financed cars before and I had student loans, but you want to know, okay, what's my interest rate? What's my realistic prospects to pay this off? I mean, I have friends that incurred, $250,000, $300,000 in student loan debt for a job that paid $60,000 coming out of college, and really was not like, it's not like being a doctor or going into finance where that income is going to grow a lot. So, that really concludes this program in terms of the financial tips. Just a little background. We're financial advisors based out of Orange County, California. We help folks all over the country with their investments, achieve their financial goals. We can help them with their insurance, whatever is needed. We can help with. And if you're serious about improving, your financial prospects, and making some changes, and looking at strategies that can help build wealth, give us a call, schedule an appointment. Our website's www.ttvalueinvesting.com. And if you found value in this, please give us a follow. Really appreciate it. Thanks.